Hello friends, welcome to Adda. In this video, we will see what are common investment errors made and how to avoid them. Basically, these are mutual fund mistakes that cost you lakhs. First of all, why this topic matters? This is because even good mutual funds won't help if used wrongly. Mistakes in selection, timing, or exit cost thousands in returns. Worst yet, these mistakes can break trust in mutual funds investment itself. So, in today's video, you will learn the most common mistakes investors make and how to avoid them. See, basically, these are eight very common mutual fund mistakes made by investors. These are first thing is chasing recent top performers. Next, investing without goal or timeline, over diversification, ignoring risk profile, no review or rebalancing, mix regular and direct plans, falling for NFO hype, and no debt allocation. Now let's see these mistakes one by one. Chasing recent top performance. This is a mistake because investing based on last year's ranked fund might not give you best returns because past returns are not indicating future returns. Top performers often regress to the mean, meaning top performers will perform for an year or two and they'll give average returns in coming years. You might be buying at peak valuations and later valuations might decline, which will reduce your returns. Now coming to safer alternative, check 3 to 5 year consistency instead of 1 year. Look at risk adjusted returns, which is known as Sharpe ratio. Verify fund manager stability. Now second mistake, investing without goal or timeline. This is a mistake because no clarity when you are selecting the product, can't measure success or failure, may exit at wrong time due to lack of plan. This is the safer alternative. Align each fund with a specific time-based goal. Short term means if you need money within 3 years, go for debt funds. If you have long-term goals, go for equity funds. Third mistake, over diversification. This is a mistake because holding 8 to 10 or more mutual funds is a problem because returns becomes index like, means you will get average returns, Nifty 50 returns or Sensex returns. Higher total expense ratio, difficult to track and rebalance. Safer alternative is pick 3 to 5 funds. Example like one index fund or large fund plus one mid cap fund, one debt fund or one hybrid fund, just like that. Quality over quantity is important. Mistake for ignoring risk profile. Going 100% equity for short term needs. This is a problem because high volatility when you need money soon. May be forced to sell during market crash. Losses sleep over market swings. Safer alternative is like this. Match risk to time horizon. Short term, go for debt funds. Medium term, go for hybrid funds. Long term, go for equity funds. Mistake number 5, no review or rebalancing. This is a mistake because set and forget SIP type investments might not give you best returns. Because bad funds continue eating returns, portfolio becomes overweight in certain sectors, miss opportunity to exit underperformance. Safer alternative is annual review. Every year you need to review your mutual fund portfolio. Compare fund versus benchmark and peers. Exist, exit consistently poor performance. Rebalance to maintain asset allocation. Mixing regular and direct plans is the sixth mistake. Some funds regular, uh, first of all, you need to know what is regular and what is direct plans. If you are going for regular plan, then more expense ratio will be there. Whereas in direct plans, less expense ratio will be there. Just on buying yourself, don't go for regular funds. Go for regular funds only if you are taking someone help, some experts help. Otherwise, go for direct plans. See here, direct fund saves 1% charges annually. Use regular only if you need advisor support. Otherwise, go for direct funds. Falling for NFO hype. NFO is the new fund offer. This is just like IPO. Stock market has IPO, right? Here mutual fund market will have NFO. It's a problem because NFO lack historical track record. No way to judge consistency, often launched during market peaks. Safer alternative is choose fund with 3 plus proven year record. Wait for NFO to build 2 to 3 year history. Existing funds offer better visibility. Mistake number 8, no debt allocation. Some people go with 100% equity portfolio. This is a problem because high crash risk during withdrawals, no stability buffer, panic selling during corrections. Safer alternative is use hybrid or debt mix as buffer. Age based rule, debt percentage equal to your age. If you say if your age is 30 years, go for 30% debt and 70% equity. If your age is 70 years, go for 70% debt and 30% equity. Means here you are adjusting the risk based on your age. So let's now see some more hidden mistakes often missed. ELSS overload, investing in multiple ELSS funds every year. This locks in. Here ELSS fund has 3 year lock in, right? So here you will have a problem to withdraw the money. Even if fund is not performing, you cannot withdraw. Some problems will be there. Multiple SIPs for same goal. Create unnecessary tracking and management confusion. Switching too often, trying to time the market through fund switches. Exit loads plus taxes. Don't switch funds too often. ULIP for are mutual fund confusion. ULIPs are not mutual funds. Insurance mix makes them complex and costly. Stopping SIPs in a crash. Here, if you stop SIPs in a crash, you will miss opportunity to buy at lower prices, right? So you should not stop the SIPs in crash. Ignoring expense ratio. High cost drag returns every year. Prefer low cost index funds for core portfolio. Only higher expense ratio if you are definitely want to take experts help, and if you are really taking, just don't go to some app and purchase regular funds, because you don't know who is managing that. You are not taking anyone's help, right? If you are taking some person's help, only then pay him, not checking tracking error. Large deviation from index lowers returns. See, basically index funds will have tracking error. It should be as low as possible. Frequent switching between funds, trigger exit loads and taxes. So review once annually, that is enough. Avoid knee-jerk switches. These are the present taxation rules for mutual funds. If equity is greater than 65%, for less than 1 year, you are taxed 15% on profit. For greater than 1 year, and if you are having 1.25 lakh or more profit, then 12.5% tax. For debt funds, less than 3 years is treated as short term and taxed as per slab. For more than 3 years, 20% with indexation benefit. For hybrid funds, it depends on the equity percentage. If equity is 65% or more, then equity rules as debt rules. International funds as per tax slab in short term and 20% with indexation in long term. See, uh, in mutual funds, there will be one more concept called exit load. You need to check the exit load before exiting, because if you are exiting before time period, you will have some charge. For example, equity funds might have 1% exit load if redeemed 1 year. This is not fixed but depends on the fund. Debt funds may have lower. Hybrid funds may have 0.5 to 1%. Index funds, it is usually nil, but check with that particular fund. ELSS usually nil because 3 year lock-in applies. So here are the key practical questions. Don't chase returns blindly. Check fund manager changes, AUM size, volatility metrics. Rebalance yearly. Don't treat SIP as set and forget forever. Don't treat mutual funds as fixed deposits. They carry risk. Even hybrid funds can fluctuate. Check before redeeming. Exit load, tax impact, STCC versus LTCC implications. Nominee is not the legal heir. So ensure legal clarity to avoid redemption disputes with family. Use SEBI registered platform only. Protect yourself from fraud. Verify platform registration. Report cyber fraud 1930 helpline. Government helpline for financial and fraud reporting. Direct advice regular plans. Direct typical saves 1% annually in costs. 10,000 on 10 lakh portfolio per year. Summary. Smart investing is avoiding traps. A smart investor not only chooses good funds but also avoid common traps. The winning formula is patience plus simplicity plus yearly checks equal to long-term wealth. Remember, mutual fund success is 80% behavior, 20% fund selection. C. Take action today. Review your portfolio. Are you making any of these mistakes? When did you last rebalance? Do you have clear goals for each fund? If you have any questions, drop them in the comments below. Thank you.